hope everyone's doing good. Welcome back to another lesson. First of all, before we get into it, um, it's been my fault. I haven't been able to get a weekly outlook up. I had some technical issues. I wasn't able to fix them, but I've managed to fix everything now. But I lost the video originally made, but I didn't post that because now it's midweek. So I'm hoping that tomorrow, which is a Wednesday, I'm going to record a different smaller video, do a midweek commentary instead. I'll start by showing you guys what I was looking at on the weekend and then update with what's actually happened so far and what I expect for the remainder of the days with news. But with today's video, let's get into it. I'm sure a lot of you have been looking forward to this one, right? Breaker blocks and the less commonly known one, mitigation blocks, which some of you may not have heard of. But let's get straight into it. With these videos, right, they're not going to be as in-depth. It's more so a case of me showing you guys how we recognize them and how we can start trading these, and with there's specific ways to trade each of these blocks. And I'll show you guys my understanding of when I like to use these ones. Usually with breaker blocks in specific, it is intraday, and I don't use them too often. I will be teaching you guys everything regardless of whether I use it or not, right? Because I don't really use breaker blocks or mitigations or even projection blocks too often really. But at one point or another I do, and they do come in use, right? So the first big rule to understand, right? No market structure shift equals no breaker. That's the simplest way to filter. Am I looking at a breaker, yes or no? If there is no market structure shift, there will be no breaker block. You can't have a breaker block without a market structure shift. If it is a bearish breaker block, the description for the breaker block is the lowest down close candle in the previous swing low. And if we come over to the example, what does that mean, right? We have high, we have low, high, low. In the previous swing low, which is this low, the lowest down close candle over here is the breaker block. And in this example, you guys can see, right, price, of course we have this breaker block, we move away, we trade through it, breaker blocks get traded through, and then price returns to it. Think about your normal order block. Price comes to your order block, just taps it and moves away, right? Of course, very similar what's happening here, but first we're trading through this before that takes place. And of course, a bullish example is the opposite. Looking at this, right, ignore the red box for a second. We have high low, high high, high low, high high, lower low, lower high. That is what I've taught you guys as our market structure shift. And as I said to you, without a market structure shift, you cannot have breaker blocks. That's the simplest way I can put it. Just to feel, because when I teach you guys mitigation next, it might be a little bit confusing, and you'll see why. But that's the biggest filter in the way. At the bottom, I've written the MSS plus OTE plus breaker block plus FVG. This is a model. I want everyone to take a note of this. When this model appears intraday, I love trading this. This is a very, I guess you could say, high win rate model in a way, right? And I'll get into what this is. But let's hop on the charts. Let's look at some live examples. Okay, so over here, right? Let's zoom in a little. This isn't the cleanest example, but there is, the market structure is still present. And as you guys can see, right, coming into this high, I've drawn this as a kind of like a supporting example. This exact move here is this exact move here. I've hand drawn it so it matches up. As you can see, this low lines up with this low, this high comes to this high, the next low, high, whatever, right? This is all made to line up because this is a lot easier to understand than all these wiki candles over here. But regardless, it's the same principle. This is the last low, make a high. We have a market structure shift, right? Because this low, this wick over here, let's remove these for a second, right? Let's go from scratch. This wick gets taken out, causing a market structure shift. We then retrace and we trade into this breaker block. This down close candle here is your breaker block. This candle here. And what happened for this candle to appear? We needed a market structure shift, because as you guys can see, this candle is created. We make a low, we trade higher, we trade through it first. Of course, we have this market structure shift taking place, and then we retrace into this breaker block, and of course into this imbalance as well, and then we trade away. And of course, like I said, the candles are a little bit messy, but you guys can see the principle here, right? Of course, it's that same example I showed you guys of high low, high high, high low, high high, lower low, and then the lower high retraces into the breaker block and we move away. Sorry about that, that was just my cat. Okay, back to the presentation. Okay, so for the mitigation blocks, right, these are very simple. Once you grasp it, this is very, very simple, right? First of all, ignore what this says, right? I want you to just look at this example. If I remove these red boxes, right, what would this be? This is just a normal downtrend, right? Lower low, lower high, lower low, lower high. Of course, we're retracing. At each lower low, the lowest down close candle is our mitigation block. The lowest down close candle at each lower low in a bearish example is our mitigation block, because as you can see, price is retracing to that, just tapping it and moving away. And then again here, the lowest down close candle in the low, price is moving away. Again, we are trading through them, and then we're returning, tapping and moving away. So the similarity is that we trade through them for both the mitigation block and the breaker block. But with these, you can see this is just a normal downtrend. There's no market structure shift here. And as I've said, this is a continuation trade, meaning market structure shift shows reversals, right? There's no reversal here. This is continuation. This is just getting in line with the move that's already occurring, just getting in line with the current trend. What I mean by failure swing is just a term used for these swings, because we're failing to make a higher swing up and we're coming lower. So at each lower low, we're forming a mitigation block and price is tapping into that and then moving lower. Let's jump on the charts. Okay, so this is a good example of a mitigation block. As you guys can see, you know, here price is bearish. Of course, we make the low, we make a lower high, then we come ahead and make a lower low, and then our lower high retraces into this mitigation block. The mitigation block is this down close candle, this bearish candle here. And as you can see, price trades into it and we move away. And it's quite simple, right? I'm showing you guys these examples, and I want you guys to, you know, come to the chat and show me more examples, find more examples, you know, check with me, is this a mitigation block, is this a breaker block, so forth. Again, this is 5-minute bearish mitigation block. And with identifying these examples, the more often you do it, the easier it will be to just pick these up. Because one good practice I realized over time, right, when price comes up like this, before I knew what mitigation blocks were, I knew what imbalance and order blocks were, but it was just like, what is price reacting to here? Like, what could it possibly, you know, be tapping and moving away? Because price always has a reason for reversing at a certain point, right? And in my head, I used to tell myself, oh, you know, maybe it's a, I don't know, like 3-second order block, or like it just could be absolutely anything at this point. But as you begin to like understand the arrays that I'm teaching you guys, these are just first of the two. There will be more we're going through, right? You'll see, you know, price is always tapping something. And for those of you that didn't know what mitigation blocks were, now you'll be able to see, on especially on the lower time frame, this is a very, very, you know, common occurrence. Price doesn't give you that deep OTE retrace. Sometimes it just taps into mitigation blocks and moves away. So another key point, right, and this is in my presentation, but we can just speak about it, is what is the use of these? When are we using these, right? Let's take in that example I said at first, the market structure shift, the breaker block, OTE, and the fair value gap. With that example, there's a lot of confluences going on. Of course, we have the breaker block, we have the market structure shift. Needs to be at a specific time of day. It comes to the OTE. I've explained why taking trades in premium and discount is optimal, right? We all know that by now. On top of that, there's a fair value gap, which also lands as a confluence because price will come and fill that. That is a, very nice model. And I'm just speaking about, I'm not showing you guys, so I know, you might not understand it yet. Don't worry, we will get into that. Not in this video. We will get into that very specific model and how I trade it. For now, right, what I want you guys to understand, from this swing to this swing, right, is a small range. Doesn't matter what time frame. We can ignore the time frame for now. That's just our range. Usually, we want to consider the first premium array. If we're shorting, we are considering the first premium arrays. So now I've told you guys, we have a mitigation block here. You know what mitigation block is. You also know that this is the order block and this is the fair value gap. Now it's like, which one do you use to set a trade? Think about it, right? If I've told you guys, let's say you decide to take this mitigation block, right? You enter here. Where is the invalidation of your trade? Where is your trade invalidated? Your trade is not invalidated all the way up to here. So now you tell me, is it favorable to short from here? If this is your range, you don't have a guarantee that price is gonna, drop this low. And let's just say, you've somehow even managed to get out at this low, which is the very low that price came to. That's still a 1-to-1 trade. Is that favorable? No. Of course, goes without saying, you would have missed the trade. But the first entry point I would have looked at is this imbalance. And I would have marked up, something like this if I wanted to take this trade. I don't know, we could target, let's say, all of this imbalance. And of course, like I said, the trade did miss us and it happens, right? But the whole idea of premium and discount comes under risk management. It protects you from taking trades that are too low in RR. You're always taking positive RR trades, to start with. It's just simple maths because we're shorting above 0.5 and we're, longing below 0.5. The point of me teaching you guys, these mitigation blocks and breaker blocks, what you see quite often, right? They're going to be the first array in your premium and discount. What does that mean, right? Let's just draw it out so it's a bit easier to see. Let's say we're gonna go for, okay, let's do a bearish example, right? Retraced there. Okay, cool. If we take our OTE, right, and we see this thing, the first most important thing is let's say we're bearish and we're shorting, right? We are bearish, as you guys can see, and we're shorting. Where do we want to short? In the premium, right? Once we're in the premium, we consider, there might be imbalance here. There's an order block up here. There has to be an order block before we reverse. And we will have, a mitigation block somewhere here. So now the point is, which one do you use, right? We're bearish and we know price is going this way. So do we risk trying to short from up here, right? As I tried from this imbalance, as I told you guys, I'm missing the trade, or do we just short from this mitigation block and get in with the move? Because even if price comes up here, right, but we enter the mitigation block down here, as long as it does not break this high, we are still in the trade. We are still in this move and we can hold the trade. The point is, the mitigation block needs to be in the premium if we're shorting. It needs to be in the premium. It's the first premium array that we're considering, because you'll have your mitigation block, then up here you're going to have your order block, and in between here somewhere you might have another lower time frame order block, or you might have an imbalance. But we consider the first thing that's in the premium, and if the mitigation block is here, that is what I will be using to enter. I know that might be a little confusing, but this is a very, very key point. Please make notes on this. If you have any confusion, any questions, please message me. So today's video, I'm just gonna keep it short. We don't need to go into too much detail. The takeaway from here, of course, you guys should know what breaker blocks are, what mitigation blocks are, and that last teaching I gave you guys, that is very important, because that's going to tie with the rest of the arrays that I'm going to teach you, and you'll see that's the relevance of them. What I want you guys to do is please send examples to a group chat. Please share examples with each other and talk about, is this a breaker block, is this a mitigation? And of course, tag us, any of the admins, when you do need help, because it's very key that you can identify them. The first, step in learning is learning what it is, then being able to identify it, and then third, being able to apply it and actually, use it in your trading. But yeah, that's it from me today. Any questions at all, please message me as usual.